One of the, kind of interesting issues going on right now, of course, yesterday the markets were sliding over this, this kind of ramp up in trade with China. Of course, this whole trade war situation. The U.S. government basically put Huawei, the Chinese phone maker, on a blacklist and, removing the ability of companies to import and export those products. And so that became really a kind of very tense point. You'll remember that previously the CFO of the company was arrested for quote unquote espionage, and that was expected to be used as kind of a bargaining chip with trade. That's kind of faded to the background for right now. But now this issue over the potential blacklisting of the company has now become kind of a front and center issue for China as well. The U.S. is using Huawei as a bargaining chip to try to force China into an agreement on trade. And overnight, or yesterday, the U.S. kind of backed off of that a little bit late afternoon yesterday, said that they're going to kind of call a 90-day reprieve to allow American broadband companies more time to work out a plan B with Huawei. Markets are up a little bit this morning on the back of that news. Again, just, it's the markets are hinging upon trade news from one day to the next. So, a 90-day reprieve here, a 90-day reprieve on auto tariffs for EU, a 90-day reprieve on this. And the markets are going, okay, well, maybe we're getting a deal done. We're not moving any closer to getting a deal done with China. Beijing has already gone out through their national press to their entire population saying, we're in a trade war with the U.S., stop buying their products. Beijing has now warned of unwavering resolve in the fight and accuses Washington of bullying and blackmail. And now, what Chinese ambassador to the EU warned on Tuesday, he said this is wrong behavior, so there will be a necessary response. Zhang Ming, China's envoy to the EU, said in an interview with Brussels on Monday, Chinese companies' legitimate rights and interests are all being undermined, so the Chinese government will not sit idly by. The U.S. government is trying to bring down Huawei through administrative means. Okay, so, this is all posturing at this point. Look, both sides, if there's a deal to be done, both sides have something they want. And any deal that gets done is not going to be a great deal for the U.S. It's not going to be a great deal for China, but it'll be a good deal at the end. But the problem is both sides have to get themselves in a position to actually negotiate. That's a lot of this is going on. The problem is this is not going to be resolved in a day, a week, a month, 3 months. I doubt it even gets resolved this year, ultimately. And the reason is because of this posturing and political wrangling. And as I've said before, China's in no rush to get a deal done because all they've got to do is wait Trump out of office. It's unlikely that whoever comes in next is going to support a trade deal anyway with China. They're going to be off on some other tangent. There's going to be another deal. This is Trump's deal. So it's unlikely that whatever deal gets done, if it gets done, would even start until 2025 at the earliest. The second thing is there's no real rush for China to do anything if they can wait Trump out of office. And everybody says, well, China can't last 4 more years. So, yeah, they can. They have no constraints on spending debt expansion, et cetera. They can continue to do that. They manipulate markets. They manipulate economies because they're communists. They can do this. They can outlast the U.S., which is driven by consumer sentiment, and our polls are politically driven. So if a president like Donald Trump, who has now tied his entire presidency to the value of the stock market, if that begins to crater, that ability to continue to support those asset prices through government spending, et cetera, becomes much more limited, right? Even Republicans at some point are going to stand up and start to squawk about a $2 trillion plus deficit when we get there next year. We're talking about $28 trillion in debt by the end of 2024. So at some point, even fiscal conservatives who have given a pass to the administration to spend without constraint are going to ultimately squawk. And this is going to become problematic. Again, we don't have that. We don't have the ability to run unlimited debt like China does. So this is now a point of attrition. Who can outlast the other guy in terms of this negotiation. China knows that there is a limit to how far that we can go, and they are willing to push that boundary in order to secure a better deal. Again, this is all about negotiation. Everybody wants a better deal for themselves. So don't expect for a moment this is something that China's just going to roll over and say, okay, we'll give up all this other stuff that you want just because we're good guys. That's not how they operate. So understand that this fight is going to be lasting for a while longer. China, interestingly enough, has also started to attack rare earth metals. A big chunk of the rare earth metals that we get for batteries, lithium, etc., come out of China. They're now talking about a ban on those metals coming out of China. That's going to hurt companies like Apple, Tesla, others that depend upon those rare earth metals for battery production, etc. So China is not without bargaining chips here. China is not without the ability to negatively impact the U.S. And the one thing about China is they're pretty smart about how they do things. They will target the areas that impact the consumer the most. Anybody with a lick of sense knows that the economy is driven by 70% consumption. So if you want to hurt the U.S. economy, you go after the consumer, not the government. They will do that. And they're going to impact the things that consumers use the most of. Apple products, batteries, those type of things. Once those things become extraordinarily expensive or almost impossible to get, that becomes problematic for the U.S. economy. So just pay attention to this. This is a deal that is going to take a while. Apple was down about 6.5% yesterday on the realization that this Chinese trade war is going to be lasting a lot longer, and they are a company that is directly impacted by trade. Micron, Apple, KLAC, Lam Research, AMD, Intel, all these companies, if they are a producer or a user of commodities or products that come out of China, it's problematic here in the short term. So again, the pressure is going to be on the U.S. administration to get something done sooner rather than later. And as I've said before, one of the most likely outcomes of this eventually is, and enough pressure has got to be applied. And that's going to be twofold. One, pressure from the economy in terms of slower economic growth, which we're looking right now. We're tracking about a 1.5% growth rate for the second quarter of this year. The second thing will be a much lower stock market. Those two things are going to apply a lot of pressure to the White House to get a deal done and get this off the table. The longer this exists, the bigger the impact is going to be to earnings, the bigger the impact is going to be to the markets, and the bigger the impact is going to be to the economy. So, again, kind of watch this. This is something that kind of continues to heat up here. It's not going away. There's a lot of hope this thing's going to resolve in the next couple of weeks. The markets are still holding up here near all-time highs on expectation that this trade war is going to be ramped up, just any time now. And again, the markets are up today, this morning, simply on news that basically we've temporarily eased restrictions on Huawei, which doesn't really say much of anything about where we are with the trade war. It just has eased up some of the restrictions temporarily, so people assume, and the markets are assuming, hey, good news, we're moving towards a resolution. We're not. This is part of the game that's got to be played out. So we're going to be, but this is the stuff to kind of pay attention to. Again, and particularly as we move into summer, which typically tends to be weaker months anyway, having a little bit of extra cash, extending some duration and fixed income right now will help protect portfolios from volatility. And I would certainly expect there to be a bit more volatility as we head into the summer months. Tesla. We recommended a short on Tesla in our at RIA Pro, which is our professional website, riapro.net. If you go there and check it out, you get a 30-day free trial. But we recommended a short on Tesla about 4 weeks ago. We do every Thursday we put out a long short list if we can come up with good ideas on 4 or 5 stocks to go long, 4 or 5 stocks to actually short. And they're just ideas, right? These just an idea list. Well, one of the ideas that we had about 4 weeks ago was to short Tesla, and this was due to a couple of things. But this morning, the stock is now down below $200 a share. It's down about 15% over the last week. Morgan Stanley came out this morning, and it's interesting to finally see investment companies starting to say the same thing that we've been talking about here on the show now for the last year in regards to Tesla, which is the fact that their ability to produce is going to become problematic once competition hits the market. Competition has now hit the market, and people now have a choice. If you want an electric car, you can buy Tesla, or you can buy from a company that can actually produce and service them, like Porsche, Audi, BMW, Ford, Mercedes, others, all coming to the market with their version of electric vehicles. They're nice looking, they do their job, etc. And in a lot of cases, they actually even cost less. So, but once, the Tesla had the ability to gain a tremendous amount of market share because they were the only producer of any type of quantity out there for a while. They made one mistake after another with the company. That's now come back to haunt them. And that gave their competitors time to now hit the markets. Morgan Stanley out this morning with a research note, lowering their price target below 230. Stocks below 200 already passed their target. They said the worst case scenario for Tesla is $10 a share. I don't think it'll get there. I think the company gets sold off and bits and pieces around $50 a share, but we'll see when we get there. That may be another year or so.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.